All right, very good. Well, welcome everybody. I'm happy to see so many of you signed on today. Nothing like tax topics to bring in a big crowd. Today, we're going to explore the One Big Beautiful Bill, also called OBBBA, which is a major tax law that was signed in July of 25. And today, we're going to break down what's changing, how it's going to affect the way individuals and families file their taxes for 25 and 26 and answer some common questions that we're getting about deductions, credits, and planning points under all the new rules. The OBBBA is a sweeping tax reform that makes several temporary provisions of past tax reforms permanent, and it also introduces new changes. Some are limited time only. Its aim was to simplify tax filing, and you can just insert your own joke here. It's also supposed to expand benefits for working families and seniors and provide some temporary tax relief for workers in service and middle income jobs. Here's a quick summary of some of the key changes that we're going to cover today. I will not get into corporate tax or international provisions. Of course, none of today's presentation is supposed to be specific tax advice, but rather education. It's really important that you get with your planner before year end to find out which of these provisions will impact you both this year and moving forward. After all the fretting that Congress was going to lower the estate tax levels, they set the amount a person can pass away with tax-free to be $13.99 million, indexed for inflation. And so what does that mean? Well, you don't have to worry about your estate being taxed unless you eclipse that amount. Each year, you have the ability to gift money without filing a gift tax return. You can give as many people as you wish $19,000. And for a married couple, that means you can combine those gifts to give any individual $38,000 per person. So from a practical standpoint, unless you have an estate that is larger than 28 million for a married couple, you don't have to worry about estate taxes at all. The big hoo-ha on this tax bill was that the tax brackets were made permanent. Well, as permanent as anything ever is with our government. So they kept the top bracket at 37%. People felt like that was a big win. One minor change for 2026 is that they set the base year for inflation adjustments back 1 year to 2016, but only for the 10 and 12% tax brackets. Effectively, this means that the 10 and 12% brackets will receive an extra inflation adjustment bump in 2026, slightly increasing their income thresholds compared to what they would have been without the adjustment. It isn't a major change, but it will require some extra attention for individuals recognizing capital gains, particularly when harvesting capital gains in the 0% capital gains bracket. Under the Tax Jobs Act, the difference between ordinary income and capital gains thresholds was small enough that it was generally safe to assume that someone in the 12% ordinary income bracket would also be in the 0% capital gains bracket. Now, there's a bit more space between those thresholds, and it's creating a very strange scenario where it would be possible to incur more tax by recognizing capital gains at 15% than ordinary income at 12%. Very strange, but true. And this is where when people have retired, and we have the ability before they file for Social Security to really maneuver around those tax brackets, this is something that we're going to have to watch out for. The standard deduction was permanently raised, and this means that most filers will use it instead of itemizing. It's a straightforward way to reduce taxable income. The standard deduction is taken if the total of your eligible unreimbursed medical expenses, plus your charity, plus your property taxes and your mortgage interest do not exceed the standard deduction. So the standard deduction is a very nice 31.5 for a married couple now, and this will be adjusted for inflation each year. And this should result in more filers using the standard deduction in the government's eyes, reducing complexity. In practice, you can see how the standard deduction works. More and more people, particularly in retirement, fall into the standard deduction, especially with the state and local tax. So for itemizing, you'd have to have medical expenses that exceed 7.5% of your adjusted gross income before they'll count to be itemized, plus your property tax, plus your mortgage interest, plus your charitable contributions. If all of those things exceed the standard deduction, you are better off itemizing. And we can certainly help you look through all that. A big win for the Northeastern states was the SALT cap being raised. SALT stands for state and local tax. This is one of the most impactful, if temporary, changes. For years, the state and local taxes have been capped at $10,000, meaning if your property taxes are $12,500 on your home, you only get to deduct $10,000. In states where you pay state tax, you couldn't write off more than $10,000. And for some of the states in the Northeast or in California, this was a very big deal. With the OBBBA, if combined state and local taxes are above $10,000, now you can deduct up to $40,000. So itemizing may make some sense again for some filers, especially in high income tax states or locations with high property taxes. Again, if you're married filing separate, that's only going to be $20,000. And again, you have to itemize. If your SALT taxes are high, the benefit is real. Now, before you get too excited, there were some trade-offs negotiated as a part of the SALT cap increase. And just to walk you through this, the old rule, if you paid $23,000 in state taxes and $12,000 in property taxes, you could only deduct $10,000. Now, this family is going to be able to write off $35,000. In a 32% marginal rate, that's $8,000 less in federal taxes owed. So you can see why it was a really big benefit for those states. Rarely do we see single and joint limits and phase outs being the same, but here it is. The new SALT deduction starts to phase out at $500,000 of adjusted gross income and is entirely lost at $600,000. So people are excited. They get up to $40,000 to write off. Well, if you've got two working people that make over $500,000 a year, that's going to start to reduce. And if they make more than $600,000, sorry, your limit is still going to be $10,000. The cap returns to $10,000 in 2030 unless Congress extends it. For many service workers, servers, and hourly employees, no tax on tips and overtime is a temporary but meaningful break on 2025 income. This is only for 2025. These workers can deduct up to $25,000 in tips and $12,500 in overtime in this year only. It phases out for incomes above $150,000 single and $300,000 married. It applies only to certain industries. On September the 2nd, the Treasury released a preliminary list of 68 occupations that qualify, and the complete list is due out here in a couple weeks, and they have promised that they would have it to us by October the 2nd. Well, a part of the election platform was to eliminate taxes on Social Security income. Instead, we got a new senior deduction. Yes, if you receive Social Security, you will still pay taxes on that income depending on your other income sources. The deduction phases out, however, at a rate of 6% of the amount of the household's modified adjusted gross income over $75,000 for a single person or $150,000 joint. In effect, households with over $175,000 single or $250,000 joint will be fully phased out of the additional senior deduction. This is a very big deal. For clients who have been working annually to do Roth conversions, this may bring a kink into the planning. So again, to recap, just for 3 years, there is an additional deduction of $6,000. If you're married, that means you get a deduction of $12,000. But it phases out for a joint family if you have income over $150,000. So this is a very big planning point. We are already having a lot of conversations here in the office about this, and those will continue. To show you practically what this looks like, the age 65 plus deduction, though available regardless of whether a household uses the standard deduction or itemizes their deductions, it's a below the line deduction that's taken after calculating adjusted gross income. What that means is that while the deduction does reduce taxable income and therefore the amount of tax that you owe, it doesn't have an impact on any tax provisions based on AGI, such as the taxability of your Social Security. We're going to walk through this calculation here. So let's just focus on the married filing joint. And we're saying that one spouse is over the age of 65. Here you have the $31,500 standard deduction. If you're over 65, you already get an extra $1,600 in a deduction, and the $6,000 for the new temporary over 65 deduction means that you get a total of $39,100 in a deduction. Oh, to be over 65 now. If you have both spouses are over 65 years of age, your total deduction this year will be $46,700. That is huge. Again, what the OBBBA did not do is exempt Social Security from taxation. Car loan interest for 25 to 28, 2025 to 2028 is now able to be written off. Individuals can deduct interest paid on a loan to purchase a qualified vehicle, provided the car is purchased for personal use. Leases do not qualify. It has a maximum annual deduction of $10,000. The deduction phases out with $100,000 in income for a single person or $200,000 for joint filers. The loan has to be originated after 12/31 of 24. So if you want to go out and buy a car now, it could qualify if it's a qualified vehicle. Again, personal use, not business use, and it can be secured by a lien on the vehicle. So what is a qualified vehicle? A qualified vehicle is a car, minivan, van, SUV, or a pickup truck, or even a motorcycle with a gross weight rating of less than 14,000 pounds. It has to have undergone final assembly in the United States, or it does not qualify. The deduction is available for itemizing and non-itemizing taxpayers. That's huge. The VIN number has to go on the tax return. We are still waiting on reporting guidance from the IRS. I'm sure you're surprised by that. Here is a website that we can always send to you if you're looking to buy a car this year to check to see if your car is qualifying. Starting in 2026, gamblers can only deduct 90% of their gambling losses against their gambling winnings. Previously, up to 100% of those losses could be deducted, allowing gamblers who broke even to have no gambling-related taxable income. This applies to all forms of legal gambling, whether it be in a casino, poker, sports betting, or lottery tickets. 90% deduction limit means that even if a gambler's winnings and losses are equal, they will have 10% of their winnings counted as taxable income. For example, a player with $100,000 in winnings and $100,000 in losses will be taxed on $10,000. To claim any gambling loss deduction, both recreation and professional gamblers must still itemize their deductions on their tax returns. So if you don't qualify to itemize, you're going to lose all your losses altogether. Of all the changes in the OBBBA, the changes around philanthropic giving are probably the most impactful, and this is going to touch a number of our clients here at Aspen. For the above-the-line deduction, if you don't itemize, you can only claim this for cash donations. For starting in 2026, not for 25, but in 26, taxpayers who do not itemize can claim an above-the-line deduction of up to $1,000 single or $2,000 for married filing jointly for charitable gifts made directly to eligible charities, not to donor-advised funds. And again, this will only be eligible for cash donations. So your goodwill or other non-cash donations will not count for this. Your goodwill or other non-cash donations will only count if you itemize. So beginning in 2026, those who itemize must subtract 0.5% of their adjusted gross income from their total charitable gifts before determining the deductible amount. I know that sounds complicated, so we're going to look at how that works in practice. Functionally, this year, 2025, we have work to do before the end of the year. If your AGI is $200,000 and you make total charitable contributions of $10,000, here's how that calculation works. The 0.5% of AGI is $1,000, and we consider this called the floor. The deductible amount that you will receive off that $10,000 now, you have to subtract the floor. So that means that $10,000 donation, you will only get to deduct $9,000. Here's the other rub of this. If only $800 was given to charity, none of it would be deductible because it does not exceed the $1,000 floor. This new rule applies to all charitable giving, cash and non-cash. Charitable giving carryovers from prior years, prior to 2026, are not subject to the new floor. Only new charitable donations made in 2026 or after. Again, that means that this year, 2025, brings a huge planning opportunity for those who are charitably inclined. Fund your donor advised funds. Do them this year so that you don't have these limitations. The OBBBA repealed pretty much all of the clean energy credits that were out there. To the extent that you have plans to buy an electric vehicle or undertake certain home energy improvements, it will be important to make sure that those purchases or the work are complete by the new deadlines in order to remain eligible for the credits. If you want the clean vehicle credit, you have only 11 days to make that purchase. You have to have your clean vehicle bought before September the 30th in order to receive that $7,500 credit that was put into place a couple years ago. Alternative fuel vehicle refueling property credit, if you want to put a charger into your garage or something like that, it's going away after June the 30th of 2026. This is a long time credit that has been in our code, extended over many years. Up to $1,200 toward the cost of energy efficient improvements, meaning new windows, doors, re-insulating your house, heating and cooling equipment, your air conditioners. There's a section in the code that terminates this credit for property placed in service after December the 31st of this year. If you have an air or heating unit in your home that is troublesome or old, I would strongly suggest that you go ahead and get that replaced before the end of this year so that you can claim this. Same with the residential clean energy credit. It's a 30% credit for the purchase of solar panels or wind power, geothermal heat pumps, or fuel cell equipment. That's all going to go away after the end of this year. How many of us have already forgotten about the Secure Act 2.0 that was signed into law at the end of 22? Well, it's still in effect. And there's some little known provisions in here that I think are important to bring up if we're talking about taxes. Starting in 2025, this year, those who are age 60 to 63 can make super 401k catch-up contributions. So for 2025, the enhanced catch-up is an additional $11,250. So how does this work? Well, if you're 50 to 59, or 64 and over, you can defer to your 401k plan or your 403b plan $23,500 plus your catch-up contribution of $7,500, meaning you can contribute up to $31,000 if you're 50 or older into your 401k or 403b plan. But for people who turn 60 to 63 starting in 25, you get your base, but you can also put in an additional amount up to $11,250, meaning your total contribution into your 401k plan can be $34,750 this year, but only for those age 60 to 63. Why did they choose those ages? Cannot tell you. In order to take advantage of the catch up, obviously you first have to fill the bucket of the standard deferral amount. Once participants turn 64, it reverts back to the standard over age 50 catch up contribution limit. Just this past Monday, this week, the IRS released again final regulations on the new Roth rules for high earners. The Roth catch up rule was originally supposed to take effect in 2024. However, all the payroll providers screamed and yelled, and due to problems with implementing how this was going to work, the IRS announced that the Roth catch-up contributions for high earners aged 50 and over won't be required until now 2027. It was supposed to go in effect January 1 of 26. That marks a full 3-year delay of the new rule. And what this rule is, if you're eligible to make a catch-up contribution, just like we looked at on the prior slide, because you're age 50 and over, if you earned more than $145,000 in the prior tax year, you must make your catch-up contribution into a Roth account. This means that you will not get the tax deduction on the extra contribution into the retirement plan. However, those funds will grow tax deferred and come out tax free in retirement. So again, this does not take effect now until January the 1st of 2027. Participants who are 50 and older and earn more than $145,000 in FICA wages from their employer in the previous year must make their catch-up contributions on a Roth basis. The other sticky in all of this is that you see I'm using the term FICA wages. For people who are self-employed, they don't always do FICA wages. So there's a lot still gray in that area for self-employed people. I know that that is very quick, and I've gone through a lot of technical things for you. The slides will be available. We are certainly going to have this on our channel for you to be able to refer back to. We can always send this presentation to you after the fact. But I want to thank each and every one of you for joining us today. I hope you saw something that will positively impact your planning for this year and beyond. And as always, we encourage you to reach out to our team. Planning is what we do here at Aspen day in and day out. And it would be our joy to assist you in strategic tax planning so you keep more of your hard-earned money and pay less in taxes. Our fine print, again, this presentation is not intended to give you specific tax advice. We want you to get with a tax professional or a financial planner to see how this information may impact your personal situation. Jim, how many questions do we have?
Oh, we got one. Steve, what about the tax credit for donations to an organization that grants scholarships?
I wouldn't think that if it's a 501c3 organization, that any different rules would apply.
Steve,
I could look into that. If it's not a 501c3, you can always email me separately and let me know kind of what code that falls under if it's not a 501c3 organization. For those that are philanthropic, this is your year. You need to do some really good thinking about how you're going to fund your charity going forward with those limitations that are going to come in.
Thank you so much, Helen. Everyone on this call, again, it will be available to you. It normally takes about 5 to 7 days for compliance to make sure we get cleaned up and edited for you guys. And we'll send it via email, and you'll be able to access it on YouTube or on our page at aspenwealthmgmt.com.
Thanks, everybody.